What's going on, everyone? It's Billionaire here, and let's be real, just hearing the word stock market can make it feel like you're about to walk into a casino, right? But here's the thing, long-term investing is the opposite of gambling when you know what you're doing. Welcome to our comprehensive guide on how to pick good stocks for long-term investment. We're not talking about those get-rich-quick schemes you see all over the internet. In this video, we'll walk you through a structured and strategic approach to minimize risk and maximize returns, just like how I invest my own money. Before you even think about buying a single share, you gotta ask yourself, why am I investing in the first place? Are you investing for retirement, maybe trying to buy a house in a few years, or just wanting to grow your wealth over time? Once you've got your why figured out, you gotta figure out your risk tolerance. This is huge. Are you the kind of person who can stomach the ups and downs of the market, or do you need something a little more stable? Knowing yourself is key to making smart investment decisions. A young investor with a longer time horizon might be comfortable with more risk, going for those high-growth stocks. But someone closer to retirement? They might prefer those big, stable companies that pay dividends. Let's talk about picking winning stocks. Look at the company's fundamentals, like checking under a car's hood. Check for consistent revenue and profit growth over years. Look at the earnings per share, EPS. Is it growing? What about the price-to-earnings ratio, PE ratio? Ensure it's reasonable compared to industry peers. Don't forget about debt. Avoid companies drowning in loans. Check their debt-to-equity ratio. Finally, size up the management team. Do they have a solid track record? A company is only as good as its leaders. Even if a company looks great on paper, it's crucial to understand the industry it operates in. Is it an industry with a bright future, or is it on its way out? Think about industries like renewable energy, technology, or healthcare. These are sectors with huge potential for growth. Once you've identified a promising industry, look for companies that are leading the pack. These are the companies that are innovating, adapting to change, and positioned to win in the long run. Think Tesla, for example. They're at the forefront of the electric vehicle revolution, and that's a trend that's only going to get bigger. Chapter 4. Diversification. Now, I know it's tempting to go all in on a stock you believe in, but trust me, diversification is key. You never want to put all your eggs in one basket, no matter how promising that basket looks. Spread your investments across different industries, sectors, and even countries. Think of it like this. If one investment takes a hit, the others can help cushion the blow. It's all about managing risk. A well-diversified portfolio might include a mix of large-cap stocks for stability, mid-cap stocks for growth potential, and even a sprinkle of small-cap stocks for those higher-risk, higher-reward opportunities. Chapter 5. Analyze financial statements. I get it, looking at financial statements might seem about as exciting as watching paint dry, but trust me, this is where the real insights are hidden. The balance sheet, income statement, and cash flow statement are your best friends when it comes to understanding a company's financial health. The balance sheet tells you what a company owns, assets, and what it owes, liabilities, giving you a snapshot of its net worth. The income statement shows you how much revenue a company is generating and how much profit it's making after expenses. And finally, the cash flow statement tracks the movement of cash both in and out of the company, which is crucial for understanding its liquidity and ability to generate cash flow. Chapter 6. Dividends and reinvestment. Dividends are like getting paid to own a piece of a company. They're a portion of a company's profits that are distributed to shareholders, usually on a quarterly basis. When you're looking at stocks for long-term investment, pay attention to companies with a history of paying dividends and, more importantly, increasing those dividends over time. This is a strong indicator of a company's financial strength and commitment to rewarding its shareholders. Now here's where it gets really powerful. Reinvesting those dividends. Instead of pocketing the cash, you reinvest it back into buying more shares of the same stock or other investments. This is like a snowball effect where your money starts to compound over time, leading to potentially exponential growth. In the business world, it's not just about being good, it's about being different. You want to invest in companies that have a sustainable competitive advantage, something that sets them apart from the competition and makes it difficult for others to copy. This is called an economic moat. Think of it like a castle surrounded by a deep, wide moat. It's much harder for competitors to attack and take over. Companies like Amazon, with their massive logistics network and Prime ecosystem, have built a formidable moat in the world of e-commerce. Apple has a powerful brand, loyal customers, and a closed ecosystem that makes it challenging for others to compete. Alright, let's dive in. Valuation metrics help you determine if a stock is priced right. Are you overpaying or getting a steal? The discounted cash flow (DCF) model forecasts future cash flows and discounts them to present value. Another metric is the price-to-book (PB) ratio, comparing market value to book value. For income, consider the dividend yield, showing percentage return from dividends. Let's face it, the stock market can feel like a giant casino sometimes. There are always those hot tips and speculative stocks that promise to make you rich quick. But trust me, those are usually more trouble than they're worth. Remember, you're not here to gamble, you're here to invest for the long haul. Instead of chasing the latest fads, stick to companies with clear, transparent business models, proven track records, and sustainable growth plans. Long-term investing isn't a set-it-and-forget-it kind of thing. It's important to regularly monitor your portfolio and make adjustments as needed. Life changes, goals evolve, and market conditions fluctuate. Review your portfolio periodically, maybe every quarter or so, to make sure it's still aligned with your investment goals, risk tolerance, and time horizon. Keep an eye on how the companies you've invested in are performing. Are they meeting their earnings estimates? Are they innovating and adapting to change? And don't forget about the bigger picture. Stay informed about industry trends, economic conditions, and geopolitical events that could impact your investments. One of the best ways to learn about long-term investing is to study the greats. Think about companies like Apple, Berkshire Hathaway, led by the legendary Warren Buffett, and Nvidia. These are companies that have consistently delivered value to their shareholders over the long term. They have strong fundamentals, sustainable competitive advantages, and a track record of adapting to change. On the flip side, it's also important to understand why some companies fail. Avoid companies with unclear business models, excessive debt, or a heavy reliance on a single product or market. And be wary of high-risk penny stocks or companies in declining industries like coal. Long-term investing requires patience, thorough research, and a disciplined approach. It's about building wealth gradually and steadily over time. Focus on quality companies with strong fundamentals and growth potential. Diversify your portfolio and reassess periodically. Remember, knowledge is power. The more you learn, the better equipped you'll be. Take control of your finances and build a brighter future. Get a bundle of 4 life-changing books for just $4. These books will teach you wealth-building principles and achieving your dreams. Don't miss this unbeatable deal. Order now for $4. Book link in the description.